early morning insight on trading. I'm joined by Jeffrey Smalls, president of Arbor Financial. Jeffrey, glad to have you this morning. Despite the volume in yesterday's session and even the rebound we were just mentioning a moment ago, the S&P still having its worst month since March of 2020, yet the index is, 8% away from an all-time high. What does this signal about market sentiment right now, and what are you kind of taking away amid this recent market volatility?
How much time do we have? I think unprecedented stimulus and unprecedented market valuations cause unprecedented snapbacks. So we've had this 13% decline very quickly. Expect that to continue as the market shuffles the deck and starts to reallocate into companies that are more value-based, that aren't going to have tragic earning news until we see the rate environment start to change and the geopolitical issues start to take the pressure off the market. I can go on and on about this stuff.
Oh, there's certainly a whole show that we can commit, and probably still wouldn't have enough time to kind of go on about the different factors at play here. I didn't even mention the Ukraine situation, of course, that affecting, the energy sector. Want to pivot, though, and just talk about, certainly what's happening today. Today kicks off kind of the first day of that two-day Fed meeting. Do you anticipate the central bank could course correct here on interest rate hikes or on monetary easing, really in light of just the market performance? There are many who said the Fed has to be more hawkish, but then you have yesterday's volatility, even today, kind of being on the downside here. Some saying, no, let's see, maybe the Fed should be a little bit more dovish. What are you expecting?
Well, I think the Fed is out to lunch, so to speak. They ruined the Santa Claus rally by announcing the taper in March, the first week of December. Then they ruined the January effect by saying they were going to raise rates 4 times. I don't think they can raise rates at all. Maybe 1 or 2 25 basis point moves. That's it. China just lowered rates. The economy is going to start to slow down from the snapback of all the stimulus occurring, because without stimulus, we really can't keep consuming at the current level. And so we're going to see inflation start to decompress in the second half. And I think the Fed has made 2 missteps so far. I expect another misstep today. They have the ability to either move the markets higher or move the markets lower. I got to tell you, anybody's guess is as good as mine. I have no idea what the Fed is going to do. I don't think they even know.
How do you see the scenario that you were just talking about there a moment ago in terms of inflation decompressing without interest rate hikes or more aggressive interest rate hikes?
Well, let's look at this. The Fed wants to taper in March, if not earlier, right? They've had this crazy stimulus policy, this crazy monetary policy in place that was unnecessary. It was galactically dumb. And so there's going to be a lot less consumption in goods going forward when the Fed finally tapers. In addition to that, we've got massive amounts of people quitting the workplace. We have more people leaving the workplace than entering it. And so the economy is going to have some challenges here. Without stimulus, earnings can't grow. And Wall Street right now is waiting for tragic earnings news. That's why the market's been resetting here. That's why we see an emphasis on the value trade going forward and a de-emphasis on the tech sector going forward.
Yeah, to your point earlier, listen, we could all kind of speculate what the Fed is going to do, but at least we'll get better insight in terms of the actuality of what the Fed ends up doing. Tomorrow we'll get some of those notes and we won't have to wait that long for them. But in terms of kind of earnings and the impact that earnings are having, probably even without getting a complete slaughter on earnings, you're still seeing the NASDAQ really be affected, even on just tough comparables. The NASDAQ down, nearly 13% from the all-time highs that it set back in November. Software, semiconductor sectors declined about 12% in the last 4 weeks. What is your take on the industry, its overall performance and opportunities you see within the technology sector amid this environment of concern, kind of this black cloud over the tech sector's head when it comes to interest rates?
Well, the rate market is what's upset the tech sector so badly. And so what happens is when interest rates go up, the credit facilities of these companies get compressed. It affects earnings. And prices are already overstretched. The multiples make no sense on these companies. And so that's all putting pressure in the tech side of the equation, with the potential of not matching earnings that are basically projected. And let's face it, earnings aren't going to be stellar this year for the broader market. We're looking at 7 to 9%. Now, tech should do well. I think tech will be okay earnings-wise. I don't see any tragic mistakes there, but they're overbought. Tech is dramatically overbought. It's time for a resetting of values. Companies are in the dot-com stratospheres of multiples. And that makes no sense at this stage of the cycle, especially with the economic headwinds we're going to be facing the next 12 months.
And to your point, the valuation, then, the picture comes into focus when you're seeing growth, but you're not seeing the comparable growth that we saw in 2020 and certainly 2021 on the leverage, of interest rates and that environment. So kind of with that context, right, with the interest rate, picture that we're anticipating, depending on where you fall on that, we also have Microsoft. After the close, they're going to be reporting earnings, Apple reporting earnings, Tesla, other big tech names here. What do you expect out of their earnings report, and what do you imagine, the market's reaction potentially is going to be here?
I think the market reaction is not going to be gauged on any particular earnings news from those companies that you've mentioned. Those companies are going to meet their guidance or maybe exceed it a little bit, just like J&J just did. And so there's not going to be any shocks. I think the shock in earnings is going to happen in the second half of the year. Once we finally see what the Fed's true policies are going to be, what is the interest rate policy going to be, and what's going to happen to rates, not just by the Fed, but organically. Because if we get above a 2% 10-year note organically, then we've got problems. That's going to cause the market to reshuffle. It's going to cause the market to take out some of the profits. And let's face it, there's a reason why Bezos and Musk are selling stocks. I mean, you don't have to figure this out. These things are at all-time peaks. And when we're at peaks, what happens? Trees don't grow to the sky, rockets don't grow to the moon. You take some off the table. And there's nothing wrong with taking some off the table at this stage of the cycle and then buying the dips. We've got really good buying opportunities coming up here.
So let's talk about some of those opportunities. Where do you see kind of the best opportunities there in the buy the dip strategy?
Well, I think as far as buying the dips go, whatever companies have good earnings is the key. You've got to have a company that's got good earnings. And if it's got double-digit earnings, then there's going to be some good plays out there. I like Apple. Apple's been beaten up recently, down 15%. Not a bad buy in the 150s to 140s. So pick your points of entry. Look for opportunities. Don't buy on the green days. Only buy on the red days.
Yeah, to your point there, you see kind of the overall tech pullback, even the good stocks kind of get, hit in that pullback, and then there's the opportunity to kind of pursue, the buying opportunity. Before I have to let you go here, I want to pivot to energy. Energy, obviously, the top performing industry this year so far, with that sector being up, 13% in the last 3 weeks. Tension, though, between U.S. and Russia really impacting the oil industry as energy companies kind of look to send more gas to Europe. What could this mean for the oil market, and what's your outlook for energy's performance overall?
Well, I think the outlook for energy overall is we're going to see pricing squeezes and over demands on energy, not just globally, but domestically, as global productivity is going to be 4.5% for 2022. Our own GDP this year is going to be 4%. So that's going to suck up the energy space, and demand is going to go up. And so what does that mean? We don't have the rig counts we had pre-COVID. So energy prices are going to rise. It doesn't help that the Biden administration puts pressure by canceling the Keystone Pipeline as well as canceling the expansion of exploration and oil on public lands. These are all issues that need to be addressed. So recently, the Biden administration did something that nobody thought they would do. They asked the energy industry to do what? Increase production, because this is a supply-demand issue right now. And we have 30% less rigs producing today. Companies are more focused on cash flow than they are producing energy at all costs. And so they're more focused on that, which means prices are going to rise. And there's nothing the Fed can do about it. They can raise rates to another 200 basis points. It makes no difference. We live in an oil-driven world, and until we have more production than we do demand, prices will continue to rise.
That seems to be the consensus. Jeffrey Smalls, thank you so much, president of Arbor Financial.